Hello and welcome to Pensions 101, a series designed to help you make sense of your pension. My name is Martin and today we are comparing pensions to ISAs. An individual savings account, or ISA, is a product that allows you to save money without paying tax on the interest you receive, provided you don't exceed the saving limit. Interest you earn from an ISA doesn't count towards your personal savings allowance, and your savings can be spread across multiple ISAs as long as their combined total is within the annual savings limit. With a cash ISA, you can usually withdraw money as and when you need it. There are several other types of ISA, including a stocks and shares ISA and a lifetime ISA, both of which are designed for longer term saving. A defined contribution pension is a product for saving specifically for retirement, so you won't be able to access it until you reach retirement age, apart from in very rare situations. The current retirement age is 55, rising to 57 by 2028. With defined contribution pensions, the value of your pot when you retire depends on how much you paid into it and how your investments perform over time. One of the key benefits of saving into a pension is that the government usually contributes too, in the form of generous tax relief on your pension contributions. Basic rate taxpayers usually get a 25% tax top-up. For example, if you paid £100 into your pension, you would get an extra £25 from the government, meaning a total of £125 would be invested into your pension pot. Higher and additional rate taxpayers can claim further tax relief on their pension contributions through self-assessment. At retirement age, you can take 25% of your pension tax-free, then you'll pay income tax on the rest. If you're paying into a workplace pension and meet certain criteria, your employer will also be required to pay into your pension due to auto-enrollment rules. This could considerably boost your retirement savings. Pensions are diversified and invest your money into a range of assets, including company shares, so the size of your pot can fluctuate in line with market performance. In a similar fashion, stocks and shares ISAs invest your money in company shares, making them better suited for long-term saving. You won't have to wait until retirement age to access your money, but your provider may still place restrictions on when you can withdraw your savings. Cash ISAs don't invest your money and are similar to normal savings accounts. You can usually access your money whenever you like. Just as there are different rules when it comes to saving, there are different rules when it comes to passing on your savings. Defined contribution pensions are usually held outside of your estate, which means your beneficiaries won't have to pay inheritance tax on the pension. If you die before the age of 75, your defined contribution pension can be passed on to your beneficiaries tax-free. If you die after the age of 75, your pension beneficiaries will have to pay income tax at their marginal rate. Unlike pensions, ISAs are considered to be part of the estate, so they'll be added to your other savings and assets when you die, and your beneficiaries may have to pay inheritance tax. When you're deciding whether to save money into a pension or an ISA, you need to take your personal circumstances into account. You should consider your age, when you're likely to need access to the money, and your tax relief entitlement. For many people, it can be of benefit to pay money into both an ISA and a pension, in order to enjoy the tax benefits of a pension while having access to savings in the form of the ISA. Remember that pensions are an investment, and like all investments, the value of your pot can go down as well as up over time, so your capital is at risk. For more information on pensions and other savings products, visit our Pensions Explained Centre. Thank you for watching. If you have any questions, please leave them in the comments below. Don't forget to like, share and subscribe to our YouTube channel. See you next time.